world changed on November 15th, 2024, and most people didn't even notice. While Americans were scrolling through their phones and Europeans were drinking their morning coffee, something unprecedented was happening in the financial markets of Asia. China had just initiated the largest coordinated currency dump in modern history. $3 trillion worth of US Treasury bonds, dollar-denominated assets, and Federal Reserve notes began flooding back into the American financial system like a tsunami in reverse. This wasn't gradual. This wasn't a slow diversification that economists had been predicting for years. This was surgical, calculated, and executed with the precision of a military operation. In less than 72 hours, the Chinese government, along with coordinated moves from Russia, Brazil, India, and 12 other nations, had effectively declared economic war on the dollar's global dominance. And the weapon they used wasn't missiles or sanctions. It was mathematics. Here's what you need to understand about what just happened. For the past 50 years, the US dollar has been the world's reserve currency. Every major trade, every oil transaction, every international contract has been denominated in dollars. This gave America an incredible advantage. We could print money, and the world would absorb it. We could run massive deficits, and other countries would fund them by buying our debt. We essentially had a credit card with no limit, backed by the global economy's need for our currency. But that system just broke, and the cracks had been forming for years while we weren't paying attention. The first sign came in early 2024, when Saudi Arabia announced they would accept Chinese yuan for oil purchases. Most analysts dismiss this as symbolic, a small concession to China's growing economy. They were wrong. It was a test run. The Saudis were quietly measuring how much of their oil revenue they could convert away from dollars without triggering market panic. The answer, it turned out, was more than anyone expected. The second sign was Russia's complete pivot away from dollar reserves after 2022. While the West celebrated sanctions forcing Russia out of the SWIFT banking system, Putin was building something else entirely. A parallel financial network that could process transactions, clear trades, and settle international debts without touching a single American bank or Federal Reserve facility. By 2024, this system was processing over $200 billion in monthly transactions completely outside the traditional dollar framework. The third sign was the quiet accumulation. Throughout 2024, central banks across Asia, Africa, and Latin America had been steadily increasing their gold reserves while reducing their dollar holdings. Not dramatically. Not enough to trigger headlines or panic selling. Just consistent, methodical rebalancing that flew under the radar of Western financial media. When you added up all these small moves across dozens of countries, the numbers were staggering. Over $1 trillion in reserve diversification had occurred in just 18 months. But the fourth sign was the one that should have terrified every economist on Wall Street. China had been secretly stress testing their entire financial system for a world without dollar dependence. Internal Chinese government documents, leaked months after the fact, revealed that Beijing had run thousands of economic simulations measuring the impact of rapid dollar divestment. They had calculated the optimal timing, the ideal coordination mechanisms, and most importantly, the exact threshold where selling pressure would become self-reinforcing. That threshold was $3 trillion in coordinated selling within a 72-hour window. November 15th was chosen because it was a Thursday. Asian markets would open first, followed by European trading, and finally, American markets. This gave the coordinated selling maximum time to build momentum before weekend trading restrictions could pause the action. It was also chosen because it fell between major Federal Reserve meetings, meaning American monetary authorities would have limited immediate response options. The execution was flawless. At exactly 9 a.m. Hong Kong time, the People's Bank of China began dumping US Treasuries. Not quietly, not gradually. Massive blocks of 10-year and 30-year bonds hit the market simultaneously, a across multiple trading platforms. Within 30 minutes, Treasury yields had spiked by 40 basis points. Within 2 hours, the selling had spread to corporate dollar bonds, dollar-denominated commodities, and even dollar cash holdings. But China wasn't acting alone. At 10 a.m. Hong Kong time, the Central Bank of Russia began selling their remaining dollar reserves while simultaneously purchasing gold and Chinese yuan. An hour later, Brazil's central bank joined the selling, followed by India, South Africa, and Iran. By noon, 12 countries representing over 30% of global GDP were actively dumping dollars in coordination. The Federal Reserve's emergency trading desk was overwhelmed. They had protocols for handling single-country currency crises. They had experience managing gradual reserve rebalancing. But they had never faced coordinated selling of this magnitude from this many major economies simultaneously. The traditional market-making mechanisms that usually absorb Treasury selling pressure simply couldn't handle the volume, and then the real panic began. As Treasury prices collapsed and yields spiked, American banks holding massive Treasury portfolios faced immediate mark-to-market losses. Regional banks, already stressed from rising interest rates, saw their capital ratios plummet as the value of their government bond holdings evaporated. Insurance companies and pension funds, required by law to hold safe government assets, watched decades of accumulated wealth disappear in hours. But the most devastating impact hit the repo markets. These are the overnight lending markets that keep the American financial system functioning. Banks lend to each other using Treasury bonds as collateral. When Treasury prices collapsed, the collateral value supporting trillions in overnight loans disappeared overnight. Credit markets seized. Lending stopped. The financial plumbing that moves money through the American economy clogged completely. By Friday morning, 3 major regional banks had failed. By Friday afternoon, the Federal Reserve had been forced to implement emergency lending facilities not seen since 2008. By Friday evening, President Biden was in emergency meetings with Treasury Secretary Janet Yellen, discussing options that included everything from capital controls to military responses to what was increasingly being described as financial warfare. The human cost was immediate and brutal. Retirement accounts holding Treasury bonds lost 20% of their value in 3 days. Dollar-denominated savings accounts in countries across Asia and Africa became worthless overnight as local banks couldn't convert deposits at anything close to previous exchange rates. American companies with international operations found themselves unable to repatriate earnings as currency conversion markets completely froze. But perhaps most shocking was the speed at which the global economy began reorganizing itself around non-dollar systems. Trade agreements that had been theoretical suddenly became operational. The Chinese yuan clearing system that had been slowly growing for years experienced a 1,000% increase in daily transaction volume. Russian energy exports, previously settled in dollars, switched to yuan and rubles within days. Brazilian agricultural exports, Saudi oil shipments, Indian manufacturing goods, all began moving through new currency corridors that bypassed American financial institutions entirely. The world was rewiring itself in real time, and the United States was being systematically excluded from the process. What made this even more devastating was the timing. American households were already struggling with inflation, rising interest rates, and economic uncertainty. The federal government was running massive deficits with over $33 trillion in debt. The last thing the system could handle was a crisis of confidence in the fundamental architecture of dollar-based global trade. Yet that's exactly what was happening. Foreign governments weren't just selling dollars. They were publicly questioning whether the dollar deserved its reserve currency status. Chinese officials gave press conferences explaining their decision as necessary protection against American financial weaponization. Russian ministers described dollar dependence as economic colonialism that needed to end. Even traditional allies like Germany and France began making diplomatic statements about the need for a more multipolar currency system. The message was clear: the world was moving on without us. The psychological impact was perhaps more devastating than the economic numbers suggested. For 70 years, Americans had lived with an invisible privilege that most never even recognized. When you could print the world's money, when every other nation needed your currency to function, when your financial institutions sat at the center of every major transaction, you wielded power that transcended military strength or diplomatic influence. You controlled the very medium through which global commerce flowed. That power had just evaporated in 72 hours. Wall Street traders who had built entire careers around dollar dominance found themselves staring at screens showing markets they no longer understood. Currency pairs that had been stable for decades were swinging by double-digit percentages. Trading algorithms designed around dollar-centric assumptions were generating massive losses as they failed to comprehend a world where the dollar was just another currency competing for relevance. The Federal Reserve faced an impossible choice: raise interest rates dramatically to defend the dollar and crush an already fragile domestic economy, or maintain current policy and watch the dollar's international value collapse further. Either path led to economic devastation, but through different mechanisms. They chose a third option that would have been unthinkable just days earlier. On Monday morning, Fed Chairman Jerome Powell announced that the United States would begin accepting alternative currencies for certain international transactions. Not as a primary policy, but as an emergency measure to prevent complete exclusion from global trade networks. American oil companies could now pay for foreign crude in yuan. Agricultural exporters could settle grain sales in euros or yen. Defense contractors could invoice allied governments in whatever currency those governments preferred. It was a capitulation disguised as flexibility. The Federal Reserve had just acknowledged that the dollar was no longer indispensable. But the real shock came from an unexpected source. American multinational corporations, companies that had built global empires on the foundation of dollar dominance, began switching sides with stunning speed. Apple announced they would accept yuan payments for Chinese manufacturing contracts. Microsoft began pricing cloud services in local currencies across Asia. Amazon started quoting shipping rates in whatever currency minimized conversion costs. Corporate America was adapting to the new reality faster than the government that had created their competitive advantages in the first place. The ripple effects spread through every sector of the economy. American banks that had dominated international lending found themselves shut out of major infrastructure projects as borrowing countries preferred non-dollar financing. Insurance companies that had written policies in dollars discovered their international coverage was becoming worthless as foreign clients demanded local currency protection. Even American universities faced enrollment crises as international students couldn't secure dollar-denominated funding for tuition payments. What emerged was a two-tier economy. Domestic American transactions continued in dollars, but international commerce increasingly flowed around American financial institutions entirely. The United States was becoming an economic island in a global ocean that had changed currents without asking permission. The political implications were explosive. Congressional hearings began within weeks, but the damage was already done. Republicans blamed Democratic spending policies for undermining dollar credibility. Democrats pointed to decades of foreign policy decisions that had motivated other nations to seek alternatives. Both parties demanded investigations, sanctions, and retaliatory measures against countries that had participated in the coordinated selling. But investigations couldn't change mathematics. Sanctions couldn't restore confidence that had been lost. Retaliation couldn't force other nations to use a currency they no longer trusted or needed. The most painful realization was that this outcome had been entirely predictable. Economic historians pointed to similar patterns throughout the past 5 centuries. The Spanish peso had dominated global trade until Spanish fiscal policies destroyed confidence. The British pound had served as the world's reserve currency until British debt and imperial overextension made alternatives attractive. The dollar's dominance had followed the same trajectory, and the ending was following the same script. American exceptionalism had blinded policymakers to the reality that reserve currency status was a privilege that could be revoked by the international community. When that community decided the costs of dollar dependence exceeded the benefits, they simply built new systems that worked without American participation. The speed of the transition shocked even the countries that had initiated it. Chinese economists had estimated the process would take 5 to 10 years to complete. Instead, market forces and technological infrastructure allowed the shift to happen in months. Digital currency systems, blockchain-based clearing networks, and artificial intelligence-powered trade matching had eliminated most of the friction that historically made currency transitions gradual affairs. By early 2025, over 60% of international trade was settling in non-dollar currencies. American companies found themselves paying currency conversion fees for transactions that would have been automatic just months earlier. American banks discovered they needed correspondent relationships with Chinese and Russian financial institutions to serve their own international clients. The roles had reversed. America was now the outsider seeking access to financial networks controlled by other powers. Perhaps most troubling was the realization that this shift might be irreversible. Currency transitions throughout history had typically occurred during wars or economic collapses when the dominant power was obviously failing. But America in 2024 was still the world's largest economy, still possessed the most powerful military, still maintained technological advantages in key sectors. The dollar had been displaced not because America was weak, but because other nations had simply decided they preferred alternatives. They had built those alternatives patiently, tested them carefully, and implemented them decisively when the moment was right. This suggested something unprecedented in modern economic history: a reserve currency transition driven not by the failure of the dominant power, but by the collective choice of everyone else. A financial revolution that succeeded not through conquest or collapse, but through coordination and mathematics. The implications for American living standards were becoming clear. Without the ability to export inflation through dollar printing, without the privilege of running endless deficits funded by foreign dollar demand, without the advantage of conducting international business in their own currency, Americans would face the same economic constraints that governed every other nation on Earth. That adjustment was going to be painful beyond anything most Americans had ever experienced. The first sector to feel the crushing weight of this new reality was American manufacturing. Companies that had relocated production overseas decades earlier suddenly faced a nightmare scenario. Their foreign suppliers were demanding payment in local currencies at exchange rates that made American goods uncompetitive overnight. A factory in Vietnam that had been quoting prices in stable dollar terms for years was now insisting on dong payments with daily rate adjustments. General Motors found itself paying 20% more for Chinese auto parts within a month. Boeing discovered that titanium suppliers in Russia would only accept rubles, forcing the aerospace giant to navigate currency markets they had never needed to understand. Apple's supply chain, built around predictable dollar pricing, faced cost increases that threatened their entire margin structure. But the real devastation hit American farmers first and hardest. Agricultural exports had been denominated in dollars for so long that most producers had never considered currency risk. Wheat farmers in Kansas, who had sold grain to Egypt for decades, suddenly couldn't compete with Russian suppliers offering ruble-denominated contracts. Soybean producers in Iowa watched Brazilian competitors capture market share simply because buyers preferred real-denominated transactions over volatile dollar pricing. The human stories behind these statistics were heartbreaking. Third-generation farming families in Nebraska faced bankruptcy not because their crops had failed, but because their customers could no longer afford dollar-based pricing. Equipment loans that had seemed manageable when farm income was stable became impossible burdens when export revenues disappeared overnight. Construction companies that had built empires around overseas projects found themselves shut out of international bidding entirely. The infrastructure boom across Africa and Asia that American firms had participated in for decades was suddenly closed to them. Chinese construction companies could offer yuan financing packages that made their bids automatically competitive. American companies could only offer dollar-denominated contracts that required borrowers to assume massive currency risk. The psychological toll on American workers was perhaps worse than the economic impact. Generations of Americans had grown up believing their economy was uniquely privileged, uniquely powerful, uniquely secure. The idea that their currency might become just another trading medium competing for acceptance was literally unthinkable until it happened. Factory workers in Detroit who had weathered automation and globalization found themselves facing something entirely different. This wasn't about efficiency or cost competition. This was about systematic exclusion from global markets because their currency was no longer welcome. Union leaders who had negotiated countless contracts around dollar wage scales suddenly didn't know how to protect their members from forces completely outside their control. The retail sector experienced the transition as a slow-motion catastrophe. Walmart, which had built its business model around cheap Chinese imports paid for in dollars, watched supplier after supplier switch to yuan-only pricing. Target faced similar pressures from Southeast Asian manufacturers who preferred local currency settlements. Home Depot discovered that construction material imports were becoming prohibitively expensive not because of tariffs or shipping costs, but because of currency conversion fees that hadn't existed 6 months earlier. American consumers began experiencing inflation unlike anything in their lifetimes. Not the gradual price increases they had known, but sudden jumps as retailers passed through currency conversion costs they couldn't avoid. A television that had cost $400 in October was selling for $600 by February, not because manufacturing costs had risen, but because the currency math no longer worked in America's favor. The technology sector, which had dominated global markets for decades, found itself facing an existential crisis. Software companies that had priced their products in dollars for worldwide distribution suddenly couldn't compete with Chinese alternatives that offered yuan pricing. Cloud computing services that had been denominated in dollars became expensive luxuries for international customers who could access similar services priced in their local currencies. Silicon Valley executives who had built careers around global expansion strategies found themselves managing contraction instead. Facebook discovered that advertising revenue from international markets was evaporating as businesses switched to local platforms that didn't require currency conversion. Google faced similar pressures as international clients moved to search and productivity platforms that offered local currency billing. The educational sector experienced a collapse that nobody had anticipated. American universities that had attracted international students for decades watched enrollment plummet as tuition payments became unaffordable in dollar terms. Students from China, India, and Brazil who had dreamed of American educations suddenly found European or domestic alternatives financially attractive by comparison. Harvard Business School, which had trained global business leaders for over a century, saw international applications drop by 70% in a single semester. MIT's engineering programs, Stanford's computer science departments, all the institutions that had defined global academic excellence became accessible primarily to students who could afford the currency premium required for dollar-denominated tuition. The healthcare industry faced perhaps the most complex challenges. American pharmaceutical companies that had dominated global markets suddenly couldn't price their products competitively in international markets. A cancer medication that had been affordable for patients worldwide when priced in stable dollars became a luxury item when currency conversion costs were factored in. Medical device manufacturers discovered that hospitals in Asia and Africa were switching to European or Chinese suppliers not because of quality differences, but because of pricing advantages created by currency stability. American medical expertise, which had been exported globally through consulting and training programs, became too expensive for most international healthcare systems to afford. The energy sector experienced whiplash as global oil and gas markets reorganized around non-dollar pricing. American oil companies that had operated internationally for over a century found themselves excluded from major projects because they couldn't offer competitive financing in local currencies. Natural gas exports that had been a growing source of American economic strength became difficult to price competitively against Russian and Middle Eastern suppliers offering local currency contracts. Exxon, Chevron, and ConocoPhillips watched their international revenues collapse, not because of production issues or regulatory changes, but because their dollar-based pricing structure had become a competitive disadvantage overnight. The shale oil boom that had made America energy independent suddenly seemed like a domestic luxury rather than a global game changer. The financial services industry, which had been the crown jewel of American economic dominance, faced an existential reckoning. Investment banks that had structured global deals for decades found themselves shut out of major transactions because they couldn't offer competitive currency hedging. Commercial banks that had financed international trade through dollar-based letters of credit discovered that importers and exporters preferred local currency facilities from regional banks. Goldman Sachs, JP Morgan Chase, and Bank of America watched their international revenues evaporate as corporate clients moved their business to Chinese, European, and regional financial institutions that could offer better currency terms. The sophisticated financial instruments that had been dominated by American banks became accessible through alternative providers that didn't require dollar exposure. Real estate markets across America began reflecting the new economic reality in ways that shocked homeowners and investors. Properties that had been purchased by foreign buyers using dollar conversions suddenly became difficult to sell as international demand disappeared. Commercial real estate in major cities faced vacancy rates not seen since the 2008 financial crisis as international companies downsized their American operations. New York City, which had been the global financial capital for decades, watched office buildings empty as foreign banks and trading firms relocated their operations to London, Singapore, and Hong Kong. The premium rents that Manhattan landlords had commanded based on proximity to dollar-based financial markets suddenly seemed unjustifiable when those markets were no longer central to global commerce. The insurance industry discovered that policies written in dollars for international coverage had become nearly worthless overnight. American insurance companies that had provided global coverage found their policies being cancelled as international clients switched to local providers offering coverage in stable local currencies. The reinsurance markets that had been dominated by American capital suddenly became accessible primarily through European and Asian providers. Transportation companies that had built global logistics networks around dollar-based pricing found themselves restructuring their entire business models. Shipping companies that had quoted rates in dollars for decades suddenly couldn't compete with Asian competitors offering local currency pricing. Airlines that had dominated international routes faced passenger defections to carriers that didn't impose currency conversion costs on international travelers. The entertainment industry, which had been America's most successful cultural export, began experiencing the economic consequences of dollar decline in unexpected ways. Movie studios that had counted on international box office revenues found their films becoming expensive entertainment options in markets where local currency alternatives were available. Music streaming services that had been priced in dollars for global markets faced subscription cancellations as local platforms offered better value propositions. Disney, Warner Brothers, and Netflix watched their international subscriber growth reverse as customers switched to local entertainment platforms that didn't require currency conversion fees. The cultural influence that had accompanied American economic dominance began to erode as entertainment choices became economic decisions rather than preference selections. Small businesses across America began experiencing the transition as a series of incomprehensible cost increases. Restaurant owners who had sourced specialty ingredients internationally found their suppliers switching to local currency pricing that made their menus unaffordable. Boutique retailers who had imported unique products discovered that their overseas vendors preferred local currency transactions that eliminated their competitive advantages. The franchise model that had allowed American brands to expand globally began working in reverse. McDonald's, Starbucks, and other iconic American brands found their international franchisees struggling to pay dollar-denominated licensing fees and supply costs. Some franchisees began switching to local competitors that offered similar products without the currency conversion burden. Perhaps most devastating was the realization that these changes were accelerating rather than stabilizing. Each month brought new announcements of major corporations and governments switching away from the dollar-based systems. Each week revealed another sector where American companies were losing market share to competitors, offering local currency alternatives. The momentum had shifted so decisively that even American allies were quietly reducing their dollar exposure. Canada began pricing energy exports to the United States in Canadian dollars rather than the traditional USD denomination. Mexico started requiring American agricultural imports to be paid in pesos. Even the United Kingdom, America's closest financial ally, began offering sterling-denominated alternatives to dollar-based trade finance. By spring 2025, the transformation was visible in everyday American life. Gas stations displayed prices that fluctuated based on international currency markets rather than just oil prices. Grocery stores posted signs explaining currency surcharges on imported foods. Electronics retailers offered financing programs to help customers afford products that had become significantly more expensive due to currency conversion costs. The American dream itself was being repriced in real time, and most Americans were discovering they could no longer afford it. The transformation we've witnessed isn't just an economic shift. It's a fundamental reordering of global power that happened faster than anyone thought possible. In 72 hours, the financial architecture that had governed the world for half a century simply ceased to exist. The dollar didn't collapse because America became weak. It was displaced because the rest of the world decided they no longer needed it. What makes this moment unprecedented is the speed and coordination. Previous reserve currency transitions took decades and usually accompanied wars or economic collapse. This time, it happened through mathematics and planning, while America remained the world's largest economy. That's what should terrify you about what comes next. The signs were there for years. The warnings came from serious people. But the sound of money being made was louder than the voice of caution. America believed its own story about permanent dominance, permanent privilege, permanent exception to the rules that govern every other nation on Earth. Now we're learning what every empire learns eventually. The system that made you powerful can disappear overnight when everyone else decides to build something different. The privilege of printing the world's money was never guaranteed forever. It was a temporary advantage that required constant maintenance, constant respect, constant recognition that other nations had choices. We forgot they had choices, and they chose differently. If this story changed how you see America's place in the world, if you finally understand that economic dominance is not permanent, then you're seeing what most people still refuse to acknowledge. The old world ended on November 15th, 2024. The new world is being built without us, and pretending otherwise won't change the mathematics.